Okay everyone, welcome back to the Price Action Labs YouTube channel. In this video, I'm going to be going over how I caught 1.2R and made almost $1,000. So I'm going to be going over an in-depth trade recap. I'm going to be going over all my concepts. I'm going to break everything down to the T. Every single concept that I use in the whole of my futures trading for ES, I'm going to reveal in this video, okay? So before we get into it, I'm just going to introduce FlowState because the FlowState software is what I use. It's the FlowState operating software and it has everything you need. Premium pre-market playbook, the education hub, and speaking to me directly. So let's get into it. This is the premium footprint execution process. And every single trade I take comes down to the premium footprint execution process. All 4 P's will determine your success, okay? So let's dive into the actual trade recap. So the trade itself did not have spectacular follow through, and I'm going to break it down. So here was the trade, right? This was the trade on ES futures, right? So Friday the 12th of June, caught probably around 1R. That's all I caught, 1R, 1 to 1. Yeah, nothing spectacular. So if we break down the execution came at around 74.45, right? Stops at around 74.37. and made about 847 on the day. Okay, so we're going to be breaking down this entire framework and we're going to be breaking down this entire trade recap. Just to take things back a little bit, let's start off on the 4 hour. So I've not made a video on the 4 hour for a long time. Let's see where we are. Now, truthfully, I don't really use the 4 hour that much in my analysis, but I'm going to use it now because I've had a few questions about it recently. So first, we're going to start off with the 4-step positioning process, right? So the 4-step positioning process looks something like this. You want to use market structure, targeted liquidity, equilibrium, and price imbalance, right? These are the 4 steps to finding your key level. And I want you to think of every trade you take as being like this table, okay? Being like this table. So if you look at my charts on the 15-minute time frame, these are all very specific key levels, right? In gray. All these key levels here are very specific areas. Even today, the trade I took at around sort of 11:15, 11 o'clock Eastern, it came off one of these key levels. So when I plan my session, I always have my key levels intact, right? So this is what my chart looked like before the session began. It is important that you also have your key levels defined. And your key levels are like a tabletop, right? Imagine you're going to put something on this tabletop. If one leg is missing, if your structure is off or your equilibrium is off, you don't know your premium and discount, it becomes very sort of unstable, quite literally, right? Looking at this definition. So the 4-step positioning process is a 4-step system that I use to position my trades repeatably and effectively. So starting on the 4-hour time frame, if we go back, let's go to the 4-hour time frame. So on the 4-hour time frame, it looks something like this. Okay, so we use market structure. That's going to be what S stands for, right? This is S. So we see high, low, then we had, for me, this is our low, this is our high. Then from here, this is going to be our high. Then we had a breakdown here, okay? So from a 4-hour perspective, these are my basic structural points, right? So what we had is we had high, low, high, low, high, low. Next, we move on to T, right, which is targeted liquidity. Targeted liquidity basically means the most recent high and the most recent low. So the most recent high and the most recent low. It looks something like this, okay? So here's where we have it. We have the structural high and we have the structural low, just like this, okay? Now, from here, hopefully you can see we have come from discount because we're below the 50%, and now we're heading towards premium. Okay, and that's what the E stands for, because the E is the equilibrium. It splits the high and the low, right, with this equilibrium over here. Next, last but not least, we have price imbalance, right? So imagine what we've done. We've gone structure, targeted liquidity, equilibrium, price imbalance, and then we reach our key level using the 4-step process. Okay, I've kind of gone through it quite quickly, but that's basically, or that's essentially the bread and butter as to how I find my levels. Okay, so on a 4-hour time frame. So if we just break this down again, we have our price imbalance areas. Okay, so price imbalance, otherwise known as the FVG, we're gonna have, there's a fair value gap. So I choose the candle before. There's one over here. There is also one up here as well. Okay, so The premises of this trade was prices looking to rebalance this area of inefficiency. That was the higher time frame bias. Okay, so if we go down now to a 15-minute time frame, on the 15-minute time frame, we had our levels from the previous session, right, or the previous day. Now, this is one thing I want to explain to everyone. So I was talking to one of my students recently about this, and I want to take time in this video to explain it to every single person. Now, these were my levels, and I want to explain roughly why they were levels, right? And I want to just break these down. So if we get rid of the Asian range, what you're going to find is this. When you're choosing levels, this is an example of a very good level, okay? So this was a price imbalance over here. So this region here in blue, this is a price imbalance, okay? So once you've got your structure, your targeted liquidity, your equilibrium, then you move on to price imbalance. And the price imbalance gives you your key level. This is how you achieve the highest level of positioning. So imagine you're building the table. So you've got your structure, your targeted liquidity, your equilibrium, your price imbalance. You need all four of them acting as four legs to a table to make your trades stable, right? If the table is unstable, then your trades will be unstable. So it's very important that you really buy into this and ingrain this analogy into your brain. So going back to the charts now, here's our key level. And what you'll notice is that this is also Monday's high. Right, so let me just write this down over here. This is Monday's high. Or this is a previous day high of some sort. It doesn't have to be Monday, Tuesday, Wednesday, or Thursday, or Friday. This is just a previous day high, and it's left a price imbalance. Now, what does this mean? Okay, a previous day high, or a daily high, basically means that there are what we call buyers, or aggressive buyers, exhausted. Right, this is where buyers were exhausted. This is where passive sellers stepped in and drove price down. This is the high of the day. Okay? Now, taking this logic further, what you will find is this. Okay? The best trades on the following day will come from one of these previous day high areas. So Tuesday's pretty big sell-off of the week. So it was this Tuesday the 9th. This sell-off came from this key level here. Right? Previous day high price imbalance. This is this is very important to understand. This is going to come into logic on the Friday trade, which I'm going to break down. So Friday's level came from this price imbalance here. Okay, now is this a previous day high or previous day low? No, not really. This was the previous day low. Okay, this was the previous day high. This here is kind of in between. So it's not a high, or it's not a low. Now that doesn't mean you can't use it as an area of supply or demand. You can still use it because price left an imbalance, and of course we had some reactions. You just want to remember that, quote unquote, the strongest levels or the most dominant levels will be the previous day highs and the previous day lows. So I'll give you another example to break this down. Right? I'll give you one more example. If you look here, right? If you look here, we actually had a price imbalance. This was the imbalance here. And this was also the imbalance here. So what you'll notice is this was the previous day low, or the daily low from Monday. This was Monday's low, right? And it actually was Tuesday's low as well, right here. So this was a very strong key level. It's, of course, left price imbalances here. We had the previous day lows. Now, what do you notice on Wednesday? Right? What do you notice on Wednesday? Right? If you take this from Tuesday and Monday, and you go to Wednesday, Wednesday's short happened off here, right? Wednesday's massive follow-through trade, this is the key here, follow-through, happened from a previous day low key level, okay? So what was going on here? We had two things. We had a price imbalance, or an FVG, and we also had a previous day low, okay? Here we had a price imbalance up here. Here we had a price imbalance, and we had a previous day high, right? Follow-through. So I'm going to be using this trade recap as an opportunity to explain to you, or show you, where the trade follow-throughs are. Now, keep an eye out on this level, right? So this middle level over here. So now if we go to Friday, my pre-market plan, it looked something like this. So we had the previous day low, we had the previous day high, all right? This follow-through area came from a previous day low level. Now, the trade which I took on Friday, this one over here, came from key level 1. Key level 1 did not come from a previous day high or low. Keep that in mind, right? Keep that in mind when we look at the trade recap. Here was the trade execution, and this was the actual trade itself. So we're going to be going through the mechanics of that trade, right? Just to break it down one more time. Just remember this, okay? Just remember this. Previous day low gives us the follow through we're looking for. Big follow through, okay? Previous day high over here gives us big follow through. So this is key level 1, key level 3, key level 2. Key level 1 and 3 were based off previous day highs and previous day lows. They gave us the follow through. My trade on Friday did not come from a previous day high or low. Now this is it may be a new concept to some people. Go and back test this concept. It will blow your mind when you actually see it, right? But the reason why this trade did not have the follow through that I wanted it to, because I was really going for here, right? I wanted a 1 to 2, right? I moved my stops to here. Eventually I wanted a 1 to 2. We only went up to a 1 to 1, right? That's all we had here. We kind of stalled here, and I took profits at around 1 to 1, right? 1 to 1.1, okay? So this is what I want to break down, right? Even my execution was a bit late, right? I should have executed maybe down here. I executed here. This is my break line. And I'm going to be going over why I executed on this trade, right? Using this key level. And more specifically, another key level I took from the session was here, right? Again, price imbalance, candle before. This is how I find my key level. Now, if you're not used to finding key levels like this is going to be an absolute game changer for you, okay? This is going to be an absolute game changer for you, right? So this is where the move started to take place. So it was not the biggest trade in the world, probably about 1 to 1, 1 to 1.1, 1 to 1.2. But I want to sort of break down my logic, why I took the trade at this level, and what processes and systems that I use to take it. Okay, so let's just break it down completely. Let's actually go here. All right, let's start with this. So already going into this particular trade, we were almost at 11 o'clock Eastern, or 11, well, almost 11, 10:55 Eastern. So my goal was I wanted to see a break, basically, above here, and I wanted to see some kind of retest to target here. This was my sort of trade idea. This is how I was looking at the trade. So if we now go back to flow state, let's break down the precision entry. Okay, so precision comes down to the bolt breakout blueprint. So break, optimal retest, liquidity absorption, and then you want to pull the trigger. So step 1 is you want to see a break. You want to see a candle break above or below your zone. This is where energy starts to build. So I want you to look at the spring. All right, imagine a spring. When you see a break, this is a form of energy. This is the market showing you direction, intent, strength. One break above your level with a body, here or here. So in this case, you want to see a body break. If you look at the candle or the chart, this was the body break here. That to me was the body break. Now, my execution truthfully should have been around here. It wasn't, right? My actual execution, I waited a little bit longer. The reason I waited longer, I'll be honest, hesitancy. I was a bit hesitant. You know, we had a choppy day yesterday. I didn't trade yesterday. I was expecting chop, so I really wanted to see the market. Because usually I would be happy to enter here, sorry. Usually I would enter here. This would be my entry. I'd have my stop over here. In recent times, I'll be honest, I haven't been comfortable getting in, you know, with these tight stops. I would rather give the trade a little bit more time to develop, and hence why I had a break line up here. So my execution for this day came at 74.45, 75.45, let's say. 74.45, so let me write this down. 74.45, 45.39. So there was my entry. So my entry was actually up here. Okay, there was my entry. I did eventually trail my stop to around here, and only caught about 1 to 1. I trailed my stop up to here, so only caught about a 1 to 1. Okay. Now, why did I execute this trade, right? What kept me in the trade? So I had a little bit of drawdown, a little bit of break-even time, and then, of course, target was hit eventually, right? So what made me stay in the trade? And I'm going to be breaking this down from the lens of the Bolt breakout blueprint. So first we had a break. That's step 1. There's your break. Okay, so looking at flow state, we want to see a break. This is where energy starts to build. Now, after you've had a break, the next thing is an optimal retest. So price returns into the zone, and each candle is another turn of compression. So I want to link a coil, a spring coil, to the absorption of aggressive sellers. And this is what I mean by that. If we look at the footprint charts here, for example, and we look at the order flow here, and even here, what's going on very specifically is this, right? We are actually seeing markets coming back in, and we're seeing moves higher. We're seeing moves higher. Now, in all these three situations, what are we seeing, right? What are we seeing? So, picture for me a spring, right? Imagine a spring. So, if price breaks higher, right? Imagine the spring over here. This is the spring. Now, when you compress a spring, you need to put downwards force, right? Downwards force, right? Imagine you're pushing a spring down, right? When you put downwards force on a spring, there's going to be energy stored in that spring. The deeper the compression, the greater the potential energy. Now, if when you let go of the spring, right, you can either break the spring down to the ground, or the spring will bounce back up. Now, from the standpoint of the market, this is exactly how you want to look at demand zones or support being formed. This is exactly how you want to look at it. Now, in this case, imagine the spring being compressed, right? So this is where we go on to this is now the optimal retest more than two candles, and you want to see a body coming back into your zone, right? So we had that. We had obviously more than two candles, and we had a body coming back into the zone. Okay, even here we had the bodies coming back into the zone. So I want to focus now on liquidity absorption. What does liquidity absorption actually mean? So here's where we go. Here's where we go into it. Imagine now we're going back to the spring. Imagine the markets pushing down on a spring. These are the aggressive sell orders. Aggressive sell orders are actively trying to push the spring down. There is some force or there is some pressure hitting the zone downwards. Now, for a buy trade, sellers keep hitting the bid. You see that red delta starting to build up. So when you see the spring being compressed downwards, this is negative delta or aggressive selling. Okay, so what does that look like from a footprint chart perspective? So from a footprint chart perspective, it looks something like this. If I break this down, it looks something like this. Okay, so let's get this image up here. Okay, bang. Here we have the image. So this is the image, and this is how we want to think things through, right? What you can see here is negative delta, break higher, right? Even here, negative delta, we break above the zone. Negative delta, we break above the zone. So the analogy or the way you want to think about this in terms of how it works is it's basically the aggressive sellers are pushing down on a spring. And the spring in this case is the key level, right? The blue box here, this is the key level. So when you're looking at a key level, try and imagine it as if it's a spring. Okay, this key level here is a spring, like this. Aggressive sellers pushing price down. The spring is not budging. It's not breaking. It's not breaking. It's not breaking. So when price flies, it's like the elastic. It's like the spring has been released. Okay, the spring is being released, and that's when you pull the trigger. Okay, pressure reaches its limit. Price crosses above the break line, and that spring stored potential energy is what creates higher prices. And that's how you want to look at support, right? Vice versa for resistance, but this is how you want to look at support. Okay? And that's it. That's the logic, or that's the sort of framework that you want to think through this in. Okay? So I hope that was helpful. Yeah, so this is of course flow state. Flow state is obviously the system that I've been building. If you're interested, just feel free to comment somewhere and I'll be happy to send it over to you.